Okay, so you can actually go to the recording here. So just go to vantagemarkets.com/webinars, right? And under education and tools, click on educational webinars. This should bring you to this page, right? So essentially what we have here is that we're running webinars on a daily basis. You can see the schedule, you can see the speakers, right? And the topics that are being covered. And if you scroll down further, you can see that these are the previous recordings, right? So they're recorded and they're also posted on our YouTube page. So if you have a specific one that you want to take a look at, right, you can just click on them and this should bring you to the YouTube page. Okay. So this is an example of it, right? So now let's kickstart our session. So let me just bring up our slides. Okay, so just a quick introduction of myself. I'm Lee Sing, right? So if you're with us live right now and if you have any questions, please do put them under the questions chat. If you're watching a recording of this, please feel free to reach out to me on LinkedIn, right, for the content that we have covered, right, if you have any questions on them. So just a quick disclaimer, the information presented here is not to be treated as investment advice. It's for educational purposes only. So this is the agenda that we will be covering for today. I will first take a look at explain a bit more on market structures, right? So what constitute bullish, bearish market structures or even ranging markets, how we can actually apply them across different time frames to put together an analysis, right? So this will be looking at an analysis on euro dollar across multiple time frames, following which we will also take a look at how we can use supply and demand zones for our entry, stop losses, and profit targets. So for after this, right, we will take a look at our risk and trade management concepts, right? So in terms of shifting to break even and when do you want to take partials. So this is the agenda that we will be covering for today, right? So let's take a look at market structures. So before we kickstart, or even before we dive deep into looking at how we can combine multi-time frame analysis, we need to first understand market structures. So in general, right, there are three types of markets that we can look at: markets in an uptrend, markets in a downtrend, and markets moving sideways. So the different characteristics of them, right? So in an uptrend, we should see market form successive higher lows and higher highs, right? So this is an example of how it should look like. If you load a chart on TradingView, right? So just load any chart on TradingView. If you see, just mark out the peaks and troughs. So what I'm looking at is that I'm trying to find big movements, right? So not the small ones that we're seeing slight pullbacks, but in general, right? Just a brief overview of it. If you can identify huge movements and this pullbacks, right? Then this peaks and troughs themselves, right? So each one of them would be considered a peak and trough. And once you have marked them out, right, you can see in general where is the direction of the market heading. In an uptrend, we should be seeing successive higher lows and higher highs. You can see that in this case, right, these troughs or the lows, so the highs and lows, right, these lows themselves are not broken. So they generally hold. Whereas the highs in an uptrend, you can see that they're constantly broken. So this high itself, it's a weak resistance in an uptrend, and vice versa, right? So in a downtrend, right? So downtrend, we're seeing successive lower lows and lower highs. What's important to note is that in a downtrend, right, these highs themselves are not run. So essentially, price usually hold below this low highs, whereas the lows themselves are constant targets. So in a downtrend, right, trying to catch the bottom, we usually see that this is just a slight retracement before price continues to the downside. So this is an example of how it would look like on TradingView, right? So essentially the same idea, you mark out the peak and troughs, and you can see that this itself, right, the highs are usually holding, which means that price in a downtrend doesn't go beyond this high, right? Usually it pulls back slightly before it continues to form a new high, which is lower than the previous high here. Okay, so this is in a downtrend, and it's important to understand this concept because we are using this higher time frame. So when I talk about higher time frame, essentially it will be looking at our monthly weekly, and daily time frames, right? Using these time frames, looking at the market structure on these time frames to help us to determine the general direction of the market, and using the lower time frames, right? So lower time frames would be your H4, H1, your M30, M15, right? So these are the time frames we look at, basically trying to identify the change in market structure on the lower time frames. So I'll explain a little bit more of that, right, in detail later with our example. Okay, so the last one that we have would be markets in ranging, right? So essentially trading sideways. So in a ranging market, we are seeing price move, right, to respect both the support and resistance zone. So in this case, there are two ways to trade it, right? So one way would be straddling, trading in between, right? So selling at the resistance, buying at the support. But in this case, you can see that if it's a very narrow range, right? So if this range that we have is very tight, what happens is that on a strong break, right, of fake out, so essentially if price wick slightly below to sweep these zones, right? So these areas of liquidity. So essentially you can see that at every support and resistance level, right, there will be orders lying just slightly below these zones. These orders can come in two forms, right? One would be stop losses. So if traders are buying at the support levels, what happens is that they usually put their stop loss slightly lower, right? So if you're buying, stop loss, it's in the opposite direction, right? So these are sell orders. Likewise, right, the other kind of trading, right, would be breakout traders. So essentially, breakout traders are waiting for a break below the support level for price to continue to the downside before taking the trades. So in this case, right, breakout traders would put their sell stops slightly below the support level, right? So in an event that it breaks out, they're able to capture this huge move down. So these are the two types of concepts, right? So essentially trying to play the reversal or trying to play the breakout. But what happens in both cases is that for reversals, right, stop losses would be lying slightly below. This come in a form of sell orders, and sell stops, right, for the breakout traders lying slightly below here too. So what happens is that below this, we have this sell side liquidity, right? So essentially sell orders lying slightly below the support levels. And the same would apply for our resistance zone, right? So buy orders lying slightly above in the form of buy stops. For breakout traders waiting for a huge move to the upside, and they'll ride on this wave. The other type would be, of course, sell orders, right? So the stop losses for the sell orders for people waiting to play this reversal. So in a sideways market, right, what happens is that you can see price would move and respect both the support and resistance levels. In this case, we don't see a clear direction, right, or a clear market structure. We don't see clearer highs or clearer lows, right? Prices are just moving sideways, and we can see acknowledgement of both support and resistance levels. So personally for me, right, in this kind of structure, what would be good would be to wait for a clear break and close below either of this, right? So a breakout of this range, and for price to close below before playing in the direction of the trend, right? So if price breaks and close below the support level, right, you can see that there will be a new structure that's being formed. And once there is that pullback, right, we can wait for price to come into a supply zone to take the shots. So it's important to wait for a break and close below. And the idea behind this is because you can see, as we explained earlier, right? So for support levels, there's sell side liquidity lying here. And these orders, right, come in the form of stop losses for the buy orders. So if you're buying here, right, we'll put our stop loss slightly below. Or it can be from the breakout traders, right? So traders who are waiting for a huge move to the downside and having their sell stop triggered on the way down. So notice that at this point, right, this would be the sell orders here. So it's also common that when you see these ranges, right, especially an area where price respected the support resistance zones multiple times, right? In this case, what happens is that we could be seeing liquidity sweeps. So essentially a huge wick that taps into these areas of liquidity, right? So a huge wick that comes down, sweep this liquidity or sweep this order, essentially trigger this order before moving in the opposite direction. Okay, so in this case, right, this would be those huge wicks that we see on the charts, right? So essentially, if you see a clear support resistance area, price coming down and pushing through to these levels, right? And then when price closed, it actually closes above the zone. So in this case, right, we can see that this huge wick, right, which represents a strong rejection, it's usually in the form of liquidity sweep. So price coming in to tap on these orders before moving in the opposite direction. Okay, so this is for ranging markets. Right now, let's take a look at our charts. Okay, so we'll take a look at these concepts and also highlight a bit more on supply demand areas, understanding how it works and how we can use them. So let's take a look at that. Okay, so in this case, right, what we have, just share this. Okay, so first let's understand a bit more on market structure, right? So as we have mentioned earlier, right, let's take a look at euro dollar in this example. You can see on euro dollar, right, we have prices in a downtrend, right? So you can see on the higher time frames. So we use the higher time frames to help us to determine the general direction, right? So on the higher time frames, it can be on your weekly, on your daily, right? So essentially trying to find if prices are in an uptrend or downtrend, right? So what I want to do is to focus on the most recent price development. So somewhere here. So this would be anywhere between 2 to 3 months back, right? So you can see over here, right, what we have. So this is the picture on the daily time frame. We have price forming higher lows and higher highs coming into this zone, right? So if I were to mark out the peak and troughs of this, or even if you have to switch it into close, right? So this is probably easier to identify. So for those of you guys who are not familiar with it, right, you can just switch it into close and just identify the peak and troughs. You can see successive higher lows and higher highs being formed here, right? So if I were to mark out the highs and lows, you can see this case, right? It forms new highs and lows. And in an uptrend, right, you can see these lows themselves are not broken. So if you were to mark out these lows, you can see that the lows continue holding. And the first sign of a change in structure would come in here, right? So if the uptrend, right? So let's take a step back, right? So if we're here in time, right? We can see that if the uptrend is to continue here, we would see price continue forming again this bullish structure. But what happens instead is that following this, right, we can see that this is the last low that's being formed. You can see this low here. So the last low that's being formed, price pushed higher. And if we were to put it back into candlestick charts, you can see that price did not actually break above the last high. So this is the last high that was being formed, right? Here. So you can see that price did not actually break above the last high. In fact, what it did is that it formed equal highs. So price wicked back into the supply zone before it broke structure here. So this on the higher time frame, right? This is the first sign that there is a change in structure. If you again put it back into line chart, you can see that this area itself, right, is the first sign that there is a change in the direction on the daily time frame. And again, right, the reason why there is a change in direction, it's because we are seeing very clear upwards move, right, in terms of bullish structure. This is just from a technical analysis perspective, right? Of course, if you take a look at it from the fundamental perspective, there are also interest rate decisions, right? And all this uncertainty that's going on, right? There's driving movement in the euro and dollar. Okay, so in this example, you can see that when price broke above the last high here, it did not continue this trend, right? Instead, what happens is that price formed equal highs, broke below the previous low, and did a pullback into the resistance zone, which is this area here. And once there is a sign of a change in structure on the daily, right, we can conclude that we are in a potential bearish trend, right? So following this move, right, this shows that this uptrend is unlikely to continue. And what happens is that when we are bearish on the daily, right, of course, you can also add in other indicators, right, like your descending channel. So for example, this, right, so descending channel, essentially the idea is the same, right, bearish market structure coming in. But again, if I were to put this in close, you can see that the subsequent highs and lows that we have to mark out here, you can see that it's showing bearish structure, right? So recall earlier when we talk about bearish market structure, it's essentially price pushing to form lower lows and lower highs. And you can see this across different time frames. So when price comes into the daily zone and it starts forming a bearish structure, we go on to the 4 hours time frame, right? So recall that the first trigger of bearish structure, it's on the daily. So let me just clear all these drawings. Right? We just need to mark out when is the first sign that daily turn bearish, right? Which is this area here, because price broke below this last low, right? So following that break, this is a sign that we would not see the uptrend continue. So if you go on to the 4 hours time frame, 4 hours time frame, now that we have established that the daily time frame is bearish, following that break, right? What happens is that we're trying to find supply and demand zones. So if it's bearish, we're trying to find supply zones that we can enter or take trades from, right? So in this example, right? So what I would qualify as a supply area, right? It's basically looking at how price interacted with the zones earlier. So what I look out for, right, would be candles essentially with an extremely long wick, right? So an example of what we would have on the 4 hours, right, would be this candle here. You can see that this looking for supply zones to sell only comes in after this daily confirmation. When price breaks below structure and the trend turns bearish on the daily time frame, right, we're trying to find if there are areas that we can sell. And these areas that we're trying to find, right, supply zones, essentially would stem from candles with extremely long wicks, right? So in this case, right, this would be one candle. And we will take a look at, I'll explain a bit more on why am I looking at these candles, right? So essentially the idea is that you can see if we're to put our focus on this candle here, this long wicks on the 4 hours, right? So this is the candle that I'm looking at, this candle here. You can see that this candle, right, this long wick that we're seeing on the 4 hours time frame, if we move down to the lower time frame, essentially this represents consolidation on your lower time frame. What this also shows is that it's a range that price has been trading within, right, before it breaks out of this zone. So recall that when we talk about breakout earlier, we talk about how prices are ranging sideways. And in this case, right, there are a lot of liquidity lying slightly above and below. So what I would do is to wait for price to break and close above this zone before a retest of this area, right, to take the shots. So in this case, right, what happened here is that you can see, right, so we're waiting for price to break this zone. And this range that we're seeing over here on the higher time frame, it's usually represented by candles with relatively small bodies and long wicks, right? So it can be what we call doji. So for those of you guys looking at candlestick patterns, right, these are usually dojis. It represents uncertainty, right? There's this tug of war coming or buying pressure between the sellers and buyers, right, before price breaks out of the range and continues in the direction. So that's the picture on the 4 hours, right? Now let's focus on this candle itself, right? The one that we've highlighted, and we move down to the 30 minutes or 1 hour. So we can clearly see the range here, right? So if you move to the lower time frame, you can see that this is a range that price has been trading. Okay, so you can see this area. So essentially, this is that support and resistance level that we've been trying to find before price breaks the zone. You can see this area here, price coming in to test it as both a support and resistance. Oops. Right, so you can see price coming to test this zone. So this range that we're seeing, right? So essentially what we've highlighted on the 4 hours, right? If you go on to the lower time frame, it's basically the range that we're looking at. And this range, right, can actually be identified on your higher time frame just by looking at candles, right, with doji patterns, right? So essentially doji candlesticks. So in this case, you can see this is the range, right? And what happens is that price came in, it tested this range, right, held within this range before it broke below. And this is the break and close that we're waiting for, right? So once price breaks and close below this zone, right, then this range itself becomes a supply region. Okay, so this supply candle, there are a few ways you can do this, right? One way would just be to extend this range out, and you can see that when price breaks and close, it fails below this low, right? So if breaks and close below this low, this range serves as a supply zone where you can take your shots from, right? So this is one area. So this is one way to identify the range. The other way to do it, right, would be to take a look at the candle. So once you've identified the candle with the long wick, this doji pattern, right, the other way would be to take the last candle that still held within the range. So this, it's the low. So this candle itself would then serve as the last candle, right? The candle that still held within the range before that break. So this can be, right? So if you're looking at a change of hands between supply and demand, right? When demand fails, it creates supply. This then forms the new zone as the supply. Okay, so this would differ, right, based on different charts, or rather different symbols, right? So different currency pairs, they would have different characteristics to them, but the idea is pretty much the same, right? So you can either use this range following that break as a supply, right? Once you have established a higher time frames direction. So that's one, right? So let's take a look at this example, right? So again, right, we follow through with this. We have this range here, right? So again, this doji represented by small candles and a relatively long wick, right? So this is the candle here, this zone. And again, right, once this fails, you can extend this across, right? So we're waiting for a break and close of this range, right? So the break and close comes in here. You can see that when price breaks and close below, right, the trigger comes in following this candle here. So when price breaks and close below, you can see that it retested this zone again before it continues to the downside. Okay, so that's one, right? So again, this is using the first method to identify the range. The second method would be to look at the candle that held within. So you can see if this is the range, this is the candle that still held within the zone before it broke. So this then becomes the new supply. So again, right, it's the same idea, right? The range might differ slightly depending on which method you use, but you can see price again broke through, retested before it continues to the downside. Okay, so we have the same idea here. You can see again this wick here, right? So this is the wick. I won't say that this is the best setup, because if you compare the length of the body to the wick, right, it's at least more than 50% of this zone, right? But if you extend this across, you can see that again, right, this is the candle that held within, the last candle that held within the wick before the failure. In this case, price did not actually test the zone, right? I think we missed it just slightly before it continues lower. Okay, so the idea is the same, right? So we apply this concept, right? You can see this zone again, right? We have this huge wick, right? So this whole candle itself, right? We are seeing that range. So price coming into this zone, hovering before it breaks and close below, right? So the breakout comes in here, price broke and closed below this zone, right? So using the first method, this itself, when supply fails, it creates demand, right? So this, when demand fails, it creates supply. Following that break and close, you can see the price pull back into this zone, right? That's the first method, right? If you're using the second method, right, then that would be identifying the last candle that held within this range, right? So again, this is demand. So if you're using the second method, this is demand. The last candle that held before the break of this low that we're seeing here, that's this candle as supply, right? So in this case, we might have missed it. Yeah. So in this case, we have missed it. You can see using the second method. Okay. So of course, with the second method, right, the range that you are looking at is much lower, which means that if this is your entry, right, you could be getting out of this position, but you can choose to put stop losses either above the wider range, or if you want to keep it tighter, right, you can put it above this range. So of course, the stop loss will be much more narrow. And if the trade plays out, right, it translates to higher risk to reward ratio, right, as compared to using the first method. But of course, on the flip side, right, if price pulls back, right, in this case, we might have missed the setup. Okay, so this is the idea, right? So you can see that for supply demand zones, right, we can use them, but again, we need the higher time frames to identify the general direction of the trend. And that higher time frame can come in the form of market structure, right? So if there are changes in market structures on your higher time frame, that's when we can use that to determine whether we want to focus on trying to find supply or demand areas, right? So if prices are in a bearish move, right, or in a bearish direction, then that's when we will try to find more supply zones, right? to sell from, and vice versa. Okay, so that's on supply demand, right? And if you want to combine them with multiple time frames, right? That in this example, we saw how we can actually use the daily time frame. It doesn't have to be the daily, right? If the structure is clearer on the weekly, we can use that as well. But the idea is trying to find a higher time frame to determine the general direction. And you can use the 4 hours time frame or even a 1 hour time frame, apply the same concepts, right? And try and find the movement. So in this example, you can see here, right? So in a downtrend, we're seeing price move down, right? So in a downtrend, we can see even on the 1 hour, right? So previously, all these areas that we have we found them on a 4 hours time frame, but even this zone itself, you can see again, right? Candles with relatively long wicks here. So this area, right? You have your doji. Price failed. So again, this candle, we have this doji, price failed the zone, right? And the candle that still held within the zone itself is this move here. You can see, so if we check this low, right, this low stands at 494, and this low itself, it's at 493. So this candle failed. It broke below the low. So the previous candle that held within is this candle here. So then it became the new supply, right? So this is using the second method. If you want to just highlight this doji and extend all the way across, right, you can do that as well, right? You can see that the range that we have, right, using the different methods, it's relatively, it's slightly different, right, based on which method you want to use, but that's the idea. And again, right, when price pulls back, right, and we have again this huge wick, so these wicks themselves represent range on the lower time frame, right? So markets are ranging before it broke through, and once that breaks, right, we have again the last candle that held within this wick before this break, this candle here. So then it creates a supply, right? So we extend this across, right? So price have yet to reach this zone. So when price comes into this area, right, we can actually apply the same concept, right? So you can see that pushing into this zone itself, right, the supply area. This is the picture on the 1 hour time frame, right? So if price push into this zone, right, so this would tie in nicely with market structure. So recall at the start of the session, we talked about market structure. You can see that when price pushes into this resistance area, right, take a look at what we have on the lower time frame. It's actually showing us bullish market structure in forms of higher lows and higher highs, which means that if you want to wait for a confirmation of respect of this or acknowledgement of this supply zone on your 1 hour, right? This is the supply zone on the 1 hour time frame. If we want to wait for confirmation, right? The price did indeed acknowledge this zone. This confirmation can come in a lower time frame, right? So this would just come in the form of a change in structure, change in market structure. So if the uptrend is to continue, right, price will continue forming higher lows and higher highs. But if it does respect the zone, right, and we're seeing that change in trend, we will first see that reversal happen on your lower time frame. Right? So once price starts breaking the previous low, then this is a sign that we are seeing acknowledgement of this zone, and this would then be aligned with our higher time frame. So recall on the daily, right, we're bearish, and on the daily, right, that sign of a change in trend or change in structure comes in here, right? So this is the trigger when price broke below the last low, right? Because the assumption is that in an uptrend, we would see price continue to form higher lows and higher highs. But once it failed the previous low, right, this is the first sign that daily has turned bearish. We then move on to the 4 hours to try and find supply and demand supply zones, right, to sell from in the direction of the daily time frame. So supply and demand supply zones, right, we found by looking at range. So price breaking out of this range, and this range are usually identified with higher time frames dojis, right? So dojis itself on the lower time frame just represent a range, right? So we wait for a break and close below, right? So if we're selling, we are waiting for a break and close below the low, which basically just means that price broke and closed below the range, and this range now serves as supply. Right, we saw a few examples across the different time frames. On the 1 hour, you can see that the same concept would apply, right? So essentially price breaking below this wicks, failing it and retesting the zones. And if you take a look at it on the lower time frames, you can see that if price were to pull back into this resistance areas, right? So if it pushes into this resistance areas, you'll be seeing a bullish structure coming into this zone, right? Because it's doing a pullback, and this whole bullish structure forms the higher time frames pullback link. And for confirmation, right, we just need to wait for that change in structure. which then shows that price did acknowledge the supply zone, and we could be seeing further move down in the direction of the higher time frame. Okay, so I hope that this is clear, right? So essentially using market structures across different time frames, right? Trying to identify supply demand areas and trying to use this higher time frames direction and supply and demand areas together, right? So that will help us to identify the zones, right? And lastly, right, if you want to wait for your lower time frame confirmation, right, it will always come in a form of change in structure, right, on the lower time frames. So given the fractal nature of markets, right, if you're seeing any kind of reversal on your higher time frame, let's say on the daily, right, so going back to the same daily example, if you're seeing that break in structure happen on the lower time frame, sorry, on the daily time frame, right, so focusing on this portion of the chart, let me just hide this in purple, right, so this is the reversal that we first see on the daily. If you move to the 30 minutes or even a 1 hour time frame, shrink it back slightly, you can see that this move itself, right, the reversal or the change in structure already happened on your lower time frame. It can be the 30 minutes, it can be the 1 hour, right? But the idea is that if you put these levels in close, you can see that the first sign of reversal, right? So again, mark the peak and troughs, right? You can start forming, you can see that lower lows and lower highs have really started forming here. Right, so mark up the peak and highs, lows. You can see that you have subsequent lower lows and lower highs. And this bearish move that we're seeing on the lower time frame forms the higher time frame, the daily pullback leg. Okay. So I hope that this is clear so far, right? So this is basically what we want to highlight, right? So throughout the session, we have been talking about market structure, right? The idea is very simple, but it's very powerful when you can combine them across different time frames. And once you have used the higher time frame to establish the general direction of the trend, we look at the lower time frames, right? In terms of supply demands, looking at dojis, trying to find the wicks of the candles, because this dojis on the higher time frames basically represents a ranging markets on the lower time frame. We saw a few examples on the 4 hours, right? So once price ranges, right? So this doji is basically which is characterized by relatively short bodies and long wicks, right? So an example of this. So you can see that this doji itself would form the range on the lower time frame, right? If you go down to the 1 hour or 30 minutes time frame, you can see that this is a range that price broke out from and retested, right? Which is why you can just highlight the doji on the higher time frame, extend it across, it forms your supply zones. Okay, but of course, right, determining whether you want to find supply zones or demand zones really depend on the direction on the higher time frame. Why would we focus on finding supply zones? It's because on the lower time frame, right, the daily, we're seeing that change in structure, right? So if you mark out the highs and lows, you can see that price broke below the last low. And following that break, this is when we want to focus on supply areas that to find areas to sell from. Okay, so this is how we can combine market structures, supply demand zones across different time frames, trying to find the higher time frames for direction and lower time frames, right? The dojis, essentially candlestick patterns for a range that we can take shots from. Okay, so I hope that this is clear, right? So with that, we have come to the end of the session, right? If you guys have any other questions, please feel free to put them under the questions chat, right? If not, that's what we have for today. Okay, so if you want to watch a recording of this session, right, it will be recorded. It is being recorded, right? So you can just go to Vantage Markets YouTube page. It will be posted there after. Okay, so with that, we have come to the end of this session, right? That's all that we have for today. So thanks everyone. Have a great weekend, and we will catch you guys again next week.